Hello, everybody. Thank you for joining me. In the past, I've done some pretty introductory videos, mortgage 101 type stuff. What is a credit report? What is escrow? What is an underwriter? Because of where we are economically, I figured um, we should maybe it was a good time to take a little deeper dive, get into the 201 stuff. So today I wanted to talk about the housing market and liquidity. Those are two terms that you will probably be hearing more often or have heard in the news most recently, just with everything that's going on. So I want to start with the housing market. When I'm talking about a housing market, it's not just the amount of homes that are being bought and sold today in Honolulu, in Hawaii, in California, in the United States. When I'm talking about the housing market, I'm talking about more of the money side, the back end of it, the mortgage side, the finance side. Whose money is really the one being lent out to that? How did that create a market? Um, and then how does that really impact our mortgage pricing day to day? And liquidity, at its base, liquidity is going to mean your access to cash. In this sense, it is still access to cash, but it's going to be more so about access to money to make loans, to make mortgage loans. So that's housing market and liquidity to start off with. Um, I'm gonna go kind of deep dive on here. It might be a little bit of a longer video, but I really feel like to get to the end and explain it in the whole way, we really just got to start from the beginning. So let's get it. Okay. Back when, I don't even know when, but let's just say like the 50s, um, banks were lending their own money, right? A bank makes money by one, taking in deposits. So it takes in $500,000 of deposits and it says, hey, I for in exchange for you depositing your money with me, I'm going to return a 2% interest rate, right? Your savings rate. And while the bank holds that money, they go out and they make loans with that money at 5%, and then they make the 3% difference there. And that's how the bank generally, very basically, makes money. But back in the day, right, the bank is saying, okay, I have $500,000 here. I can either one, lend it to person A to buy their home, or person B who has a business and lend it to them. Typically, what we see, big board coming on, I'm going to break this down big time. Typically, what we see is that commercial loans or business loans are going to be priced a little higher. And then also, to the flexibility of a business loan is that they're renewed annually. So if it's not working out in year one, yeah, switch it to somebody else, right? What we know about mortgage loans is that they're fixed rate and they're there for 30 years. So if I'm a bank, I have $500,000. Am I going to choose to lock up my $500,000 at 4% for 30 years? Or am I going to go out and make a business loan every single month, or excuse me, every single year at 6% and have the ability for that to be increased or decreased because of the economy? You get a little more flexibility here. 6% is more than 4% returns. So if you're um, the bank manager, I'm sure you're going to go for this 6%. Now, what that does is there's no money here for the guy that wants to buy their home because the bank just lent out their 500,000 to this guy. No liquidity, right? Kind of back to our introductory term. No liquidity here. There's not a lot of access to capital to finance people for mortgages. So what happened back when is we created what was called a mortgage-backed security, MBS. And Fannie Mae is the one that kind of organizes this. And it's one of the entities. They're not the one that like invented it, but they're one of the entities, and I'll get into that. So we want to provide liquidity to our market. We want to be able to provide money so that we can make a 4% 30-year fixed rate loan to somebody. Because owning your home is the American dream and it's backed by collateral. So it's a good loan. Um, what happens is Fannie Mae now says, hey, if you bank person here, which now there's three of them in our next example, that's kind of what we evolved to. If you are able to make a $500,000 loan and it fits all of our criteria, 740 or more credit score, they're going to put 20% down. They're going to be a single family home. It's going to be their primary residence. If you're going to follow all of our rules, then we'll go ahead and just buy that loan from you. Okay? So what happens is Bank A says, no way, that's pretty cool. So it goes and makes two mortgage loans for $500,000 each, right? But now it's out. It's $500,000. It can't make its normal loans. So, right, Fannie Mae said, we'll buy that from you because we know that it's a good mortgage. It's got good credit scoring. All the factors are there. So you give your $500,000 mortgage to Fannie Mae. This is a small arrow going up into them. And Fannie Mae says, for that, we'll give you back $505,000, right? And so this bank here is saying, all right, I made two mortgages for $500,000. Here's one, here's the other. And Fannie Mae said, all right, here's $505,000 back, here's $505,000 back. This bank now has its $1 million that it lent out back in here to lend again, and it made its $10,000 profit. So it's making money, it's lending, making loans to people, and it has its original capital base back. So that's pretty cool. Now, you might be thinking, and of course now Fannie Mae offers that to all these FDIC insured banks. So everybody's kind of doing this. 500, 500, 6 times right here, right? And Fannie Mae says, I'll buy them. I got it. So everybody, all these three banks made $1 million in loans. They made their $10,000 and they still have their $1 million to go ahead and do it again or to continue lending to other things. So that's kind of cool. Fannie Mae provided liquidity in that sense so that they can make mortgage loans. Now, Fannie Mae doesn't have an endless amount of money to continue buying these, so this is where they created the mortgage-backed security, right? Fannie Mae has this mortgage-backed security. Again, Fannie Mae didn't create it, but for this example, that's what they do. Fannie Mae takes all 6 of these loans at $500,000 each and creates one big blob thing, which is what I drew it as. And this whole thing is worth $6 million, right? They bought this all, or well, I guess they bought it for $6,030,000. But $6 million of mortgages in here. Now that this is all one thing, we can now call this a mortgage-backed security. It's no longer 6 individual mortgages. It's one mortgage-backed security. It's a bond. And a bond is different than a stock. A stock is a percentage ownership in a company, like when I buy some stock from Tesla or Apple. A bond, when you buy a bond, it's a promise to repay. So they're a little bit safer in that you've been promised to be repaid. So Fannie Mae creates this big old mortgage-backed security, takes it to Wall Street, and says, hey, all you investors, yes, my investors have no arms. Okay, all you investors, if you invest and buy this mortgage-backed security for $6 million, I promise to repay you your $6 million back plus interest, right? And every single month, 1, 2, 3, 4, 5, 6, these guys are making their monthly mortgage payments. And that mortgage payment goes right here, goes into their thing, and then they're paying back the investors right down here. So yes, they're saying, all right, 6 million bucks. All 10 of us have $6 million. We'll buy this. And over the course of the next 30 years, they're going to make back their $6 million plus interest, right? If these mortgages are at 4%, maybe by the time it gets here, it's a 3% rate of return. Okay, so that money, that $6 million, right, goes back to Fannie Mae because this mortgage-backed security was purchased. And now Fannie Mae has $6 million to do it all over again. And so in this case, we've provided liquidity to our mortgage housing market. This is our market, this little circle of life of money and mortgages and helping people to buy their homes, just all from just one mortgage down here. Okay. And so again, that $6 million lets them do that all over again. Now, that's our housing market. Liquidity what we've done here is we've provided liquidity to our housing market, whereas before we weren't very liquid, right? And we didn't have this access to these investors for just one single mortgage, because that's kind of a weird thing. When you package it all up, you make it big, you make it attractive. Now investors on Wall Street see, oh, this is pretty nice. Now, investors have an option of what to invest in, okay? Stocks have an annual average rate of return of 10%, okay? And this is especially important now because of where we are and just that we've all ate it on the stock market recently. So right, this is a very, not very, but buying stocks is risky. 10% is the average. That means it could be 20% this year, down 10% next year, 10%, right? So what happens is when in times like this, sorta, normally when the outlook is bad on the stock market and things aren't looking so good, people are more likely to invest their money into bonds. And again, our mortgage backed security is a mortgage bond. So, what we see is that in times of uncertainty, people are taking their money out of the stock market and into the bond market because you know what? It's a little sketchy right now. I don't need 10%. What I need is a sure 3%. Or you hear about diversifying your portfolio. Um, you don't want to put all your eggs into one basket. You want some safety. You want some sure promise to repay. And so a lot of times you are invested in a lot of bonds. The return is a lot lower, but at least here with the bond, you have a promise to repay. Somebody's home is on the line here. And as they make payments backed by collateral, you're receiving now this 3%. Now, why I bring up liquidity in this time here is that although we're seeing people take their money out of the stock market because of the uncertainty, we're actually not seeing many institutions, many investors reinvest into the bond market. That's pretty scary, frankly, because we like to think that these are the smart guys, right? A Goldman Sachs, a Wells Fargo, big hedge fund investors, Credit Suisse, right? So they're not even confident enough to invest right now in the bond market, which is, again, a scary thought because how could you not invest in something that has a promise to repay you back, right? That's backed by a home that has collateral. Anyway, that it's a pretty bleak indication. And that's what we're seeing now. And what I want to tie that all in with is we have the federal government down here. That's supposed to be like the capital or something. The federal government says, okay, you know what? Nobody's buying bonds. And whenever people stop buying bonds, it slows down our liquidity, right? Investors aren't buying bonds anymore, and they're really slowing down our little circle of life here because there's that much uncertainty in the market. So the federal government steps in and says, hey, maybe like 2 weeks ago they had this $700 billion with a B, $1 billion package that they put together. As we saw last night, the 24th, they approved $2 trillion in this stimulus package. Part of that they earmark, if you'll see and you try to pay attention, for purchasing mortgage-backed securities. They'll mention the housing market, mortgage-backed securities, mortgage bonds, the bond market. And what that does is try to kickstart this cycle back up again because it is slowing down. Um, and that's kind of what the purpose of those stimulus packages are. There's a lot of other things, but a good chunk of the 700 billion, for example, that they did 2 weeks ago, they earmarked 200 billion of that for the housing market. And so I can only imagine there's some sort of similar proration for the 2 trillion. Anyway, that package is meant to push money back into this bond market and give us liquidity into our housing market and kind of keep this thing going. Because what we did see for a while maybe about 2 weeks ago, we saw mortgage rates drop, right? And that's because everybody rushed out of here and started buying bonds. But then big institutions started to think a little bit more and they said, hey, you know what? This is a little different this time around. For some reason, we're not even comfortable buying more into this. It still doesn't seem safe. So the government says, okay, we'll step in and we'll buy it. And when, sorry, I skipped ahead a little bit, but when institutions said, oh, we're not really that excited about this right here, what they did is they slowed down the liquidity, increasing the price of our mortgage pricing. And within the span of 4 days, we saw rates go from 3.00% up to low fours. And that's because this kind of all just started really slowing down. We lost a lot of liquidity. And in order to bring those rates back down and again get this little economy going back again, federal government steps in and says, we'll contribute 200 billion. We'll contribute a part of their $2 trillion to get this going again. Okay. And that's it, guys. Sorry for the long one, but I don't know, it's kind of a timely topic, and I hope that made sense. That's about it.